In this video, I'll go over why I think Canadian energy plays are actually very compelling investments right now. Some of you may look at Canadian natural resources or Suncor energy or even a Cenovus energy. Some of the biggest players in Canada might say, what are you talking about? I missed the run up. There is no money to be made there. And I'll actually make a case why I think this could probably continue for quite some time for these businesses. And I'll explain why I added to some position recently, just a few days ago, and why I think they have quite a bit more of upside from here. First, I just want to acknowledge that of course, I do not like to see what's happening in the Middle East, but unfortunately, this is the world we live in. But when I invest, I try to be as objective and unemotional as possible. I try to look at investment opportunities as I see them. So I'm very much a pragmatic when I invest. So talking about the Iranian conflict, first of all, I am not an expert into that, but I have been reading quite a bit of geopolitical analysts, but also oil and gas analysts to get a better understanding. I've been trying to get a lot of different views as well to make sure that I have a complete understanding. And the sad reality is we are entering the fourth week of this conflict, and unfortunately, there doesn't seem to be any resolution in sight. We saw over the weekend Trump doing a taco, so Trump always chickens out and just renouncing on his 48-hour deadline, saying he would give another 5 days for negotiations with Iran instead of going ahead and attacking the power plants like he had threatened over the weekend. However, we saw also that Trump said he had good talks, and then Iran denying that there were any talks. It really seems like there's a really high risk that this continues to escalate. And I don't want to harp on that too much. Like I said, I'm not a geopolitical analyst. This is not my point. My point here being is that even if this were to end in very short order, we'd see disruptions that would go well beyond that. There would probably be some significant supply constraint until at least this summer. Now, I think it's important to understand that the kind of disruptions we're seeing, these are the biggest oil disruption in history. So it's much greater than what we saw with Russia, or even going back to the 1970s and some of these disruption there. From the estimates that I've seen anywhere between 10 to 15 million barrels per day that are being disrupted. A lot of these estimates actually factor in some additional production that's come online from other countries. So they're trying to offset, and they're also factoring in some strategic releases from countries, which will offset that a little bit. But the problem is these strategic releases are for just a defined period of time. So if the conflict continues for a certain amount of time into the future, probably another couple of months, then you really come into a massive supply disruption that would be even greater than what we're seeing right now. But even if the conflict got resolved tomorrow, we have a bunch of issues that we have to face. First, there's been some production shut-ins. And again, I'm not an expert, but my understanding is these take some time to get back online. That's why oil producers tend to wait as long as they can before doing that. And that just means that their storage is completely full and they have nowhere to put the oil, so they had to shut these in. Even if the strait reopens tomorrow, the shipping backlog is going to take weeks to get through the strait. And also, if you're a ship owner, do you really want to be one of the first few ships to go through the strait? You probably want to wait a little bit to make sure that Iran just doesn't say, sure, go ahead, and then starts shooting down ships. Refineries are configured for specific crude states, so supply chains will need time to normalize. It won't happen instantly. You have to keep in mind those ships have to get from point A to point B and then to the refineries. The other thing that we're seeing now happening more and more is not just supply disruption, but supply destruction. We saw that in Qatar with a massive LNG export hub being damaged. And if I remember correctly, Qatar is saying it would take several years to get production fully back online. So when you start seeing destruction versus disruption, then you're talking about months and potentially years on the type of infrastructure damage that happened. And really the last point here, from what I've got from experts, Iran was essentially backed in a corner, and now they've went into the mode of let's make sure we inflict as much economic pain on the US and other countries to make sure that they think twice in the future before trying to attack us again. So essentially, Iran wants to make it as painful as possible so it prevents this kind of action in the future or delays it as much as possible. So why are Canadian producers such an interesting play? Well, first of all, let's acknowledge the elephant in the room is we do have an infrastructure constraint. So in terms of actual increase in production, I think from what I've read, it is somewhat limited because of the infrastructure, think pipelines. There are some other options in place, but there's also an issue coming up in Q2 that typically some of the large companies plan maintenance operations during Q2. So oftentimes the production will actually be lowered a little bit. But having said that, Canada is really well placed in terms of benefiting of these higher energy prices from an investment perspective. Think about it for a second. Canada is actually a place where you can get some pretty secure supply of oil. Of course, it is a certain type of oil. A lot of refineries may not be suitable for that, but the reality is Canadian companies are unlikely to get disrupted by this conflict, and they will benefit from a higher price of oil, even if the Western Canadian Select comes at a discount compared to WTI, which is trading at a discount to Brent crude, which is more affected, of course, by the conflict in the Middle East. But nonetheless, all of these benchmarks are rising because what we're seeing in the Middle East. The best investment thesis for these large Canadian companies, I'm thinking here Canadian Natural Resources, Suncor, Cenovus, but a lot of them have a break-even cost per barrel of the mid to low 40s in terms of WTI. So think about how high the price is right now. I think the market is realizing that the supply disruption, even if there's a resolution to the market, will take much more time to be accomplished. And because of that, I think we're going to be looking at elevated oil prices for the foreseeable future, probably well into the end of this year, at least the back half of this year. Even though WTI is quite elevated right now, you can actually make a case that the price is quite low, especially if there's an escalation in the conflict and there's even more supply disruption or even destruction, and then you're not seeing the normal course of oil shipment resume well into this year or maybe into next year or beyond. This is where it becomes really bullish for a lot of these Canadian producers that have costs that are in the mid to low 40s typically in terms of the WTI price per barrel. I already own Canadian Natural Resources. I added a little bit to that a couple weeks ago, and then recently, on Monday this week, when I saw the price of oil drop after Trump made his taco announcement, I decided to also add some small position into Suncor and Cenovus Energy. I know Suncor has been hated for a lot of people because of operational inefficiencies over the past, but they've made a lot of progress with their new CEO. I believe he's been there now for a couple of years, and they've really got that break-even costs much lower and in line with their big peers here. So to me, a basket approach makes a whole lot of sense. Really focusing on the largest producers. It's not necessarily a position I will hold indefinitely. I really like Canadian Natural Resources as my primary position here, but my basket approach has it around 10%, and I also have a small position in Tourmaline Oil, which is more of a natural gas play. There's a couple other ways to play it, especially for the Canadian producers. You can look at the iShares S&P TSX Capped Energy Index ETF. But again, if you're going to do this one, you're almost better off doing a sort of basket approach like I'm doing, because it's very heavily weighted in those three largest producers anyways. If you want something that's a bit more balanced, then I'm using ZEO, so the BMO Equal Weight Oil and Gas Index ETF. This is a good option for someone who wants exposure across the industry, equal weighted. So that would be an easy off-the-shelf option for people looking to get exposure to Canadian energy. Just as a disclaimer, BMO ETF is a sponsor of the Canadian Investor Podcast. If you like this video, you can also find some more content from me on the Canadian Investor Podcast. We release an episode every Monday and Thursday every single week. You can also find me on Twitter, fiat_iceberg. We will be posting some more videos on YouTube, so if you're not subscribed, make sure you do. And if you enjoyed this content, please share it with a friend. It will help us grow the channel.